Hello, everybody. This is Professor Gautam Mitra. I'm from both Optirisk and Unicom. It's my great pleasure today to introduce Elijah DePalma of Thomson Reuters, who is the presenter of today's webinar. I'll first tell you a few words about Elijah. He has a PhD in applied statistics from University of California, Riverside. He then spent some time as a director of the project in which MiFID compliance was investigated. This was in Paris. And since February 2012, he has been with Thomson Reuters, a great enthusiast in the domain of quant finance and application of news analytics to quant finance. Which now brings me to the subject that Optirisk is also a provider here. We have worked with Thomson Reuters in the past. We make use of their data. And Unicom, our sister company, runs conferences in this domain. As you may be aware that we also got a handbook in this area. So without any more ado, I want to hand over to Elijah. However, I've got two more things to tell you. One, you can meet him in person in June when the event, our conference on sentiment analysis applied to finance, takes place in London. And secondly, in today's sort of routine of things, we are going to take the questions right at the end of his presentation, and you have to type in the questions. You can start typing in whenever you are ready, but we will take them all towards the end, and we'll stop about between 5 to 10 minutes before the webinar finishes. So with any further words, I'm going to hand over to Elijah from Thomson Reuters. Over to you, Elijah, on the west coast of America.
Thank you for the introduction, Professor Mitra. This is Elijah DePalma speaking from the Thomson Reuters office in San Francisco. I'll provide a brief overview of the news content scored by our news analytics system, followed by analysis of short-term news signals, and followed up with my current research agenda. I'm part of the machine-readable news team at Thomson Reuters, and listed is a sampling of products supported by my team. The pricing data I've used for the analysis in today's webinar comes from Tick History, our premier pricing data source at Thomson Reuters, and all sentiment signals are derived from our news analytics system. Below is my own classification of research agenda, starting with high-frequency research, which focuses on event-driven, low-latency signals. These can have average holding periods of 1/2 second, and for the most prominent economic indicators, such as non-farm payrolls or USDA agricultural reports, the alpha decay can be much quicker, 20 to 30 milliseconds. The middle category, termed medium frequency, refers to short-term news signals generated by aggregating news over short look-back time periods, 12 hours, 24 hours, up to several days. And the applicability may be for day trading or short-term investment horizons. This is the area I'll be focusing on in this webinar. The last category, low frequency, refers to long-term investment horizons. And here my research, which I'll mention towards the end, is focused on aggregating sentiment signals as a conditioning tool. A brief overview of our text analytics platform. In 2008, we began scoring corporate and regulatory news through our sentiment engine. We expanded in 2010 to include internet and social media through our partnership with Moreover Technologies. And in the last year, we've begun offering a deployed solution for clients where they can score their own proprietary content. One of our largest customers, a large financial institution, scores 3,000 to 5,000 broker research reports per month through this deployed solution hosted on their local servers. I'll now go on to an overview of the news content scored by our sentiment engine and used in this webinar. We maintain an archive of Reuters and third-party news dating back to 1996. Over the last 3 years, since 2011, I've listed a breakdown by percentage of the different language news available in the archive. If I decompose the English language news, it roughly breaks up into 2 equal parts with some overlap: corporate news or company-related news, and non-corporate news, which I might classify as economic, treasury, and so on. The corporate news is submitted to through our news analytics sentiment engine in real time to produce the sentiment scores available through Thomson Reuters News Analytics. If I look at the contributing sources, primarily the corporate news contributors from Reuters News, as well as other financial news wires, also RNS, the regulatory news service from the London Stock Exchange. During this webinar, I'll focus on 3 universes: UK, European, and US. For these universes, for UK I've chosen FTSE 350, and I see that the majority of the news comes from either Reuters or the regulatory news service, RNS. Stock 600 minus UK is primarily Reuters, and same with the US S&P 1500. And everything that follows for the UK universe, I'll restrict to Reuters and RNS news sources, and for the stocks and S&P, I'll restrict to only Reuters news. One comment regarding the European universe I've chosen. Stock 600, after excluding UK securities, has about 420 securities per month. I've additionally restricted to securities which are primarily traded on Central European time zone exchanges. That leaves me with about 300 securities per month, and the securities primarily traded in France, Germany, Switzerland, Netherlands, Italy, Spain, Belgium, and Austria. I'll now take a more granular look at Reuters news stories, looking at average counts by day. Before that, I'd like to look at Reuters news story. A single Reuters news story breaks in 4 different what we call news items. In this example, it's broken in 4 items. We can have alerts and articles. An alert consists of only a headline, whereas an article consists of a headline and a body. So in the example story I've shown here, there's 4 news items, 3 alerts followed by 1 article. The total time for this story broke over the course of 35 minutes, and stories typically break over several minutes up to 1 hour. In addition, there's metadata tagged by the journalists to the stories, such as product codes you can see on the bottom where the news is distributed, as well as metadata topic codes, which are keyword topic codes indicating an event that the story may be about, a geographic location, a sector, and so on. In particular, the RCH topic code I'll be using in this webinar, that's a topic code flagging broker research or broker recommendations. If I look how companies are identified in the stories, Reuters journalists tag a company using the editorial company ID RIC. This generally refers to the RIC for the primary security of that company. This can be problematic for point-in-time analysis because primary securities can change. For example, in April last month, the primary security for Google changed from GOOG.O to Google.O. Similarly, for dual-listed companies such as HSBC, journalists will use in equal parts different RICs to identify the same company. In the case of HSBC, you'll see half the news stories tagged with the HSBA.L RIC, and the other half tagged with the Hong Kong RIC 0005.HK. For backtesting and point-in-time analysis, we've mapped the editorial company ID RICs point-in-time to an organization ID, which is a permanent company identifier, and that's provided in our Thomson Reuters News Analytics output. I'll now take a more granular look at the news volumes by day. Here over my 3 different universes, from the left I have the UK universe, middle is Europe, and right is US. I'm looking at the average news volume per day and the number of news items. I've generated stacked bars to distinguish between articles versus Reuters alerts. The gray bars behind are a large cap subset, of news volume. For the large cap subsets, I've chosen FTSE 100, Eurostoxx 50, and S&P 500. So a first immediate conclusion is that the large cap companies are receiving the largest proportion of news on a given day. These are the companies with the most exposure. A second comment, if you look at the numbers above each bar, those are the number of unique companies mentioned in all the news items for that day on average. For the Stock 600 ex-UK, I have about 300 companies per month, yet on a given day, even though I may have, say, 400 news stories or news items, I'm only seeing about 100 news companies mentioned between those 400 stories. Similarly, if I look by week, I'm seeing an average of around 200 companies per week for my European universe. So the overall conclusion is that news is concentrated to a subset of companies, the companies which receive the most exposure in the media. One other comment that's important, maybe important especially for later, is that the UK news volume has a higher proportion of articles. This simply is because we're including the RNS, which is a regulatory news service, into the UK universe, and all RNS news items are all articles. So only for Reuters do we distinguish between alerts versus articles. Next, I'll take an even more granular look, looking at trading days. At the top graphs, I'm looking at news volume by 15-minute intervals, and the bottom graphs, I'm looking at trading volume, also by 15-minute intervals over the exchange times. The first thing to note is the dramatic spikes in news volume at 7 a.m. in the UK, and also in the US at 4 p.m. after market close. Now, I've looked in detail at these news spikes. 60% of the UK news spike occurs in the first 2 minutes. In the US, we see a large proportion of news occurring just after market close from 4 to 4:04 p.m., and then another 20% of that spike occurs at 4:05 p.m. The spikes in the US are well known to myself in my prior research. The spike in the UK news is a new discovery that I discovered preparing for this webinar. One last comment, which may be noteworthy when I get to results, is that the UK trading volumes are skewed more towards market close. If you look in the Europe and US universes, we generally see a U-shaped behavior with higher trading volumes at the close. In the UK, this is more pronounced for my FTSE 350 universe. So after that quick overview, I'll go into some detailed analysis of short-term news signals. Before doing that, I'll introduce the Thomson Reuters News Analytics product. Here I've taken a snapshot from my database of the most relevant fields. There's a large number of metadata fields that cannot fit onto the screen. First one is the timestamps, which are GMT times that I use for my aggregation periods. Next I have the news source. Here I'm showing Reuters as well as some other financial news wires. Then I have the identifiers for the company. So there's the RIC, which again we've mapped point in time to org IDs. And that's an important point that I need to mention, is that the news sentiment scores are entity level or company level. So if a single news item contains 4 different company mentions, then in the TRNA output, you'll see 4 different records, one for each company. So each company receives its own sentiment score in the news analytics output. The relevance score shows how relevant that company is to the news item in general. If a company is mentioned in the headline, the relevance will generally be 1. And if the company is mentioned in passing in a later paragraph, the relevance will be lower, closer towards 0. So we can filter by relevance to restrict to news items that are relevant to the companies being discussed. The sentiment scores are granular scores which represent the probability that the sentiment about a particular company in a news item is positive, neutral, or negative. So these 3 probabilities sum up to 1. If I associate positive, neutral, and negative sentiments with the values 1, 0, and -1, then I can form the expected value of the sentiment by taking positive minus negative, and this is termed net sentiment. this is, when I refer to sentiment throughout this webinar, I'll be constructing net sentiment scores from these three numbers. The novelty is another natural language processing derived field, which identifies whether or not a story is breaking news, how new the story is. So it takes the news item and looks back over different look-back periods, comparing it with all other news items that also mention that same company. But it's not looking at a company-level fingerprint. It's a vocabulary fingerprint of the entire news item to see, is this a breaking news item, or is this a recurring story which has been mentioned in the past? The different look-back periods are 12 hours, 24 hours, up to 7 days. To attempt to identify breaking news items, I'll filter to low novelty scores of 0, 1, or 2. Then we have additional metadata associated. The item counts are a count of the volume of news on a particular company over different look-back periods. We provide the headlines, which allows for keyword headline analysis. And as well, underneath you see headline analysis, our sentiment engine does additional analysis on only the headlines, trying to identify if the headline is representative of market commentary, of broker research, and also different headline tags which identify the genre of the news item. The last metadata I've shown here are the topic codes. Several other metadata, there's too numerous to list here, would be the first mention, where the company is first mentioned in the article, the body size, and so on. In this slide, I'm looking at one basic way of constructing a short-term news signal. So first I apply different filters to my tRNA dataset. I've chosen a very basic, simple set of filters where I filter by relevance, and I also filter by novelty. Furthermore, I also exclude imbalance messages. These are exchange auto-generated messages that usually come at the end of the day indicating an order imbalance. The second thing I've done is overweighted news items which are indicative of broker research. I've identified broker research by either the topic code RCH, the headline tag, research alert, or the broker action field, which is part of the output of the sentiment engine. I should add that by employing additional filters, I can dramatically improve the signal strength, but for this webinar, I wanted to have a simple choice of filters that's consistent across all three universes. In the diagram below, I'm illustrating on UK markets, executing a trade at market close, and then exiting that trade one trading day into the future, also at market close. I'm constructing sentiment signals by aggregating news, in this case, this sample, an 24-hour look-back window. And in this webinar, I've aggregated news up to 1 hour prior to market close. So I don't include any news which occurs for the UK markets after 3:30 p.m. London time. For Europe markets, that would be 4:30 p.m. Paris time, and US markets would be 3 p.m. The key takeaway is that prior to the close on each day, I have a set of sentiment scores for each company, and I can use these scores as a stock selection signal in a trading strategy. The first strategy I look at is a basic long-short trading strategy, where I look at a bin by sentiment scores into 3 bins, and the top bin, I'll equally weight the investment for all the top sentiment scores, and in the bottom bin, I'll also equally weight, and then take the long-short spread and track that over time. Now, for the 3 different universes, the 3 different lines are looking at 3 different look-back time periods. The bottom lines in black, those are benchmark index lines where I've chosen a market index ETF. For UK, I've chosen ISF, for Europe, MSE, and for the US, SPY. The next line we see up, the brown line, that's roughly a 24-hour look-back period. So I'm aggregating news over the market hours during the market trading day, all the pre-market news, and all key things to note. One, you can see, I've pointed out for the US, how the signals diminish, the number of signals per day decrease as you take shorter and shorter look-back periods. However, the signal strength increases. I've listed two different performance metrics, annualized return and also Sharpe ratio. The key point is that as you go from bottom to top, all of these performance metrics monotonically increase, i.e., as you take shorter and shorter look-back periods, the performance of your signal is increasing. Now, on that point, if we look over prior time periods, say before 2009, or in the US before 2007, 2006, we see that all three different look-back periods perform similarly. However, in later time, the shorter look-back periods, the new signal strength from those shorter look-back periods is much stronger. So my claim is that as markets are becoming more efficient, new signal strength is derived increasingly from the more recent news. This is especially true in the US markets, where we see that the longer look-back time periods have not been outperforming over the recent years. Another comment is that in the recent past, these charts are current up to Q1 2014, we see that the new signals have performed well in both the UK and European markets. The next question I'll look at is how much of this signal strength is being derived from the long positions, i.e. the positive sentiment signals, versus the short positions. So here I've done the same, taken the same strategy, but this is a long-only strategy, which is market neutral. So each day I'm equalating that top bin of positive sentiment signals, and then shorting an equal dollar amount of the market index ETF, the ISF, MSE, or SPY. One thing you can see as I toggle between these two slides, if you look at the two right graphs for US and Europe, is that for the long-short strategy, we see strong performance, whereas in the long-only strategy, we see relatively flat performance. So for Europe and US, the performance in the long-short strategies is driven by the short side. Surprisingly, to myself, in the UK markets, the long-only strategy performs well. We still see a boost in the long-short, but we're still getting a significant performance from a long-only strategy. Now I'd like to ask two questions, why we're seeing this behavior. So I give a possible explanation for the behavior on the right. Why is performance driven by the short signals, i.e. the negative sentiment? My possible explanation, hypothesis, is that people are slower to react to negative news, i.e. faster to react to positive news. As positive news breaks, people react very quickly and the signals are diminished. Whereas for negative news, people react more slowly, there's less likely to sell, and the signal persists over time, enough to be capitalized on in these daily trading strategies. I have further supporting hypothesis, evidence of the same hypothesis in coming slides. In the UK markets, why the long-only strategy performs well, I don't have a clear understanding of this. I have a possible explanation, which is untested, which is that we're seeing more information uncertainty due to the large volume of RNS, regulatory news service articles, compared to the Europe and US, where we're restricting to only Reuters articles. Now, if I take the UK market and restrict to only Reuters, I get a stronger overall result, but I'm getting very few signals per day. So the majority of news is coming from both RNS and Reuters, which is why I'm taking the sense that perhaps there is increased information uncertainty. Next thing I'd like to do is look at the alpha decay over time of these signals. So I've done this in the following way. I assume that I enter a trade at the close of day 0, and I look at different exit times, all 15-minute intervals over the trading day, over the future 1-day trading day, the future 2 days, all the way to the future 5 trading day horizon. So the first dot on the left, the first blue dot, would represent if you entered a trade at the close of day 0 and exited at the first 15-minute interval of the next trading day. You only held the position for the first 15 minutes. And here I'm using VWAP prices, over those 15-minute intervals. Now there's 3 different performance metrics I'm looking at to measure the alpha decay, and I'll go them one by one. So the first in the top row, I'm looking at rank IC, or the rank correlation between the signals and the future returns. What we see in the Europe and US universes is that the signal decays over time, which is to be expected. In the US, the correlation decay is immediate. It happens within the first day. In Europe, however, we see a slower decay. We see signal correlation persisting for up to 2 days, with a decay beginning in the 3rd day. Whereas, very surprisingly to myself, in the UK markets, we see the signal persist up to 5-day time horizons. The next performance metric I look at is a cumulative P&L. So here I'm tracking if each day I executed a trade using a fixed notional, a fixed amount of capital, and then held that position for the allotted time horizon, and did that every day and did not compound returns, but tracked my total P&L over this time period, which is a roughly 2-year time period. And I looked at the total return over time. Now, as a benchmark, I've included, what if I did the same thing using the market index ETF? So I bought the ETF at the close of day 0 and held it for the appropriate time horizon. I can track the same metric to see how the long-short strategy performs with respect to a market index. So we see similar results. We see an increasing performance in Europe in the middle graph up to about 2 days. In the US, we see relatively flat performance after the first few hours of the market open on the first day. And again, on the UK markets, we see the increasing performance over time. Finally, I'm looking at Sharpe ratios. This is a measure of risk-adjusted return. Now, one comment here is that I've used the same annualizing factor for all of the different forward-looking time horizons. Now, this is problematic because the characteristics of 1-day returns are very different from the volatility characteristics of 5-day returns. So rather than looking at whether the blue dots are increasing or decreasing, I think it's better to look at what is the distance or the spread between the blue dots and the benchmark black line, because I've used the same annualizing factor for both the blue dots and the black line. So again, we see for the UK performance increasing, and heuristically it looks to be maximized at about a 4-day time horizon. In Europe, we see strong performance over the first 1 to 2 days, and in US we see diminished performance relative to the benchmark from this basic sentiment signal long-short strategy. Now I can do the same thing for long-only strategies, and I obtain similar results. In particular, though, I see in the European markets no outperformance over the index, even in the first day, whereas in the UK markets, I see increasing outperformance over time, even beyond the 4th day, even the 5th day, and perhaps this continues later. So these results are promising for the UK market and also for the short signals on the European markets. What I haven't considered is liquidity constraints. Are these signals being generated on very tradable securities, which are highly liquid, or less liquid securities? So before getting into that, first I'll look here at the liquidity spikes arising from new signals. So what I've done each month is I've binned my universe into low, medium, and liquidity bins. Where here I'm defining liquidity as just the trailing 1-month average daily volume. Then for all the securities in each liquidity bin, I look at the spike in news and trading volume on a given day relative to its trailing 1-month average when there's positive news signals, negative news signals, or no news. And the pattern is clear. You see a dramatic spike in trading volume when news signals occur, and it's more pronounced when there's positive news signals. Now, rather than looking at overall trading volume for the whole day, I can break it down by intraday volume. In the UK market, that would be, say, 8 to 4, and then the closing volume, where I've looked at the last half hour of the trading day. I've done this only for one example, only that low liquidity bin for FTSE universe, UK universe. You can see that blue spike in the top that was around 70%. Intraday spikes to 120%, whereas at the close it's only around 40. So the conclusions I'm drawing are that, one, the intraday volume spikes are greater than the closing volume spikes. And the other important takeaway is that the liquidity restrictions you impose on trading for these short-term news signals should account for this dramatic increase in trading volume that's expected when new signals occur. One other question I'd like you to ask yourself, to answer on your own right now, is why are we seeing a greater volume spike from positive sentiment signals than from negative? I.e., why are the blue lines larger than the red lines in general? Again, I'd like to offer the same hypothesis, the same possible explanation, that people are slower to react to negative news, i.e. faster to react to positive news. When positive news hits the markets, according to my hypothesis, people react immediately, are very quick to try to capitalize on the positive news. Whereas when negative news occurs, people are less quick to act. Perhaps they're hoping that the situation will turn around, or there's an aversion to selling on negative news. I believe this is a behavioral trait of human nature. The last technical graph I have here, to wrap this up, I'm looking at how the performance of these signals performs over time for different liquidity bins. So let me start with just one graph. What I'm doing here in this event study is I'm tracking buy and hold abnormal returns, so excess returns over that market index ETF, over the up to 10 trading days. That's 2 weeks into the future. First thing, for the US markets, you see I've circled at the top market hours news. Here I had to restrict to the most breaking news that occurred in the 5.5 hours of the market trading day prior to the close. Otherwise, all of those lines would have been flat. The first point I've highlighted is that in the high liquidity bin, we're getting most of the signals. I had to bin the low and medium liquidity bins together. So in 2/3 of the universe, we're seeing only 1/3 of the signals. That's my first bullet point. The news volume in the US markets is dominated by the companies with liquid securities. We also see that dotted line, which represents the low liquidity bin. And also the red lines are the short sentiment signals. We see the 1 day drop in excess return, which I believe was driving my earlier daily performance results. If I look at European markets, I get the good result that the performance of the short signals, which we observed earlier, is due to occurring on liquid companies. So that's the solid line, which are the highly liquid companies. On the UK markets, I'm seeing both strong outperformance from the long signals on both the liquid and the less liquid companies, which is, again, a very positive result. And here I've summarized those positive conclusions. So I now present a brief overall summary and an indication of future research. So the first point of the summary is that we're seeing markets become increasingly efficient, and the basic sentiment signals are becoming more effective with shorter aggregation periods, shorter look-back periods. Now I've italicized the word basic because the approach I've taken to construct the firm-level sentiment signals is a somewhat direct and simple approach, and there certainly can be more creative alternative ways that you might construct a sentiment signal. The other key takeaway is that new signals coincide with large spikes in intraday trading volumes. If I look at the 3 markets analyzed in this webinar, one of the most positive results that was, again, quite surprising myself is increasing performance of the long signals. In all of my research, primarily on US markets, I've never seen such strong results from the long signals. And I've identified an optimal holding period of around 4 days. On the European markets, as expected, we're seeing performance driven by short signals. Fortunately, that is occurring for the liquid securities. and identified an optimal holding period of 1.5 days. In the U.S. markets, we're seeing a demand for lower latencies if we're using basic sentiment signals. And we did see historically, as expected, that the short signals are driving performance. Now for future research, my current research agenda is of a completely different nature. Rather than looking at short-term news signals, I'm looking at long-term investment horizons. My underlying hypothesis is that new sentiment is the driver of investor sentiment and ultimately investor behavior. And the same similar behavioral finance hypotheses can be applied in the long term. One of my research agenda is looking at how do traditional quant factors, value, momentum, quality factors, or well-known quant anomalies perform over long-term horizons by conditioning on aggregate market sentiment. So rather than constructing a firm-level company sentiment score, I'm aggregating sentiment over a broad sector or a broad universe of companies, and looking at how the performance of quant factors or these anomalies differs based on different sentiment regimes. I have some very exciting research results in this area, and I would invite you, if you're interested and available, to come to my presentation at the Unicom conference in June, titled Sentiment and Investor Behavior. Thank you for your participation and your time. And at this time, Professor Mitra, I'm available to take questions.
Hi everyone, this is Professor Mitra. We have the questions in the chat box, and we are going to send it one by one to Elijah, and he's going to read out the name of the person posing the question, followed by the question, so everybody else can hear the question and the answer. So over to you, Elijah.
Great, thank you. The first question comes from Michael Larson and asks, is there one overriding ID per company that eliminates the problem of multiple RICs? That's the company org ID. This is a permanent company identifier that can be used that differentiates between mergers, bankruptcies, and so on. So it's never reused. And this also highlights the strategic multi-asset aspect of the news. The news is not equity-based, but is company-based. One of our news analytics researchers is currently looking at fixed income trading strategies using our new sentiment signals, and the key identifier to track the companies is the org ID. We also provide for clients, each day we have a list of primary issue tickers, QSIP, CEDL, and ISINs for each org ID to provide a mapping to your own proprietary company identifiers or internal company identifiers. The next question comes from Navdeep Singh, which says, on slide 12, what was the performance of the long short strategy in the UK using a market hours only look back, i.e. the blue line from the other charts? So I did not include that one for one important reason that I'd like to highlight in the slide. Well, I won't go back to the slide, but if you recall the news volume by 15-minute intervals, there was a dramatic spike at 7 a.m. for the UK markets. If I don't include that giant spike, and I only use the market hours news, then my number of signals drops dramatically, and my sharp ratios drop dramatically, and the signal performance is not good. So basically, I need to include that pre-market news to have an adequate number of signals when I'm constructing the long short and long only returns. On slide 15, the benchmark returns and Sharpe ratios look suspiciously high, particularly for SPY. So the results I have, I'm confident, are reproducible. I've used the total return index values taken from DataStream. These are the same values that you'll find on Google Finance or Yahoo Finance, and I am confident in those results. The next question comes from Elias Nekakby. What are the transaction costs factored in the return in Sharpe calculation? And the answer is none. I've factored no transaction costs into these calculations. And next from Gregory Dahl, do you have research on Forex commodities trading? The answer is no, I do not. We have a tRNA product that's targeted towards commodities and energy. And I have not done research with that product. I also do not have any FX research. There's no other questions at this time, Professor Mitra.
Okay, so first of all, Elijah, thank you for doing the presentation. And I also would like to thank the people who registered and turned up and presented questions. And as Elijah said, we'll be very happy to see you at the conference where you can hear him as well as a number of other leading presenters. Thank you.